The big round recently was because of the COVID pandemic. All the governments incurred enormous trillions of dollars worth of debt, and their central banks helped finance that government borrowing by creating trillions of dollars. And that pulled us out of the COVID depression and set off a boom with all of the new money they created, especially in terms of asset prices. And it also caused high rates of inflation. Now, to fight the inflation, the central banks have increased interest rates very significantly. And even more importantly, I think, now they are instead of creating money, as they were doing through quantitative easing, now they're doing the opposite. Now the Fed is destroying $95 billion every month through quantitative tightening. And that's sucking the liquidity out of the financial markets. It's like just, imagine a ballroom full of investors, and suddenly the Fed starts taking the air out of the ballroom. At first they don't notice, but then it becomes hard to breathe and they all run to the exits. So we're right now where liquidity is getting tight, and it's probably going to be very hard on the financial assets in the months and quarters ahead. So in terms of interest rates, they've increased the federal funds rate from 0 to now 5.25%, 5.5%. So that's really very radical interest rate hiking in such a short period of time, just about 15 or 16 months. But in terms of quantitative tightening, they are literally taking $95 billion a month out of the financial system and destroying it. $95 billion adds up over a year. That's $1.1 trillion, or about 13% of all the dollars. So this is, rather than pumping money into the system, making everything appreciate, now they're sucking the money out of the system. And we're getting to the tipping point where I'm afraid that asset prices, especially the stock market, which is very expensive, but other asset prices as well are likely to suffer and perhaps take quite a big tumble, because they're really very expensive compared to their normal levels. So they're very vulnerable to a correction.
Right. What that means for those who on the macro side is when the Fed creates money, it puts money kind of into the system via our big banks like JP Morgan, Wells Fargo, and all that. And then you and I walk up, and businesses walk up to JP Morgan, Wells Fargo, and your local bank, your regional bank down the street, and then you borrow money. So money comes into existence via debt. When the Fed takes money out of the system, that means there's no debt being created. That means no money is entering the system. And where it shows up right now is credit card debt is at an all-time high because mom and pop don't have any money. And plus inflation due to this Green New Deal stuff that Biden's doing, cutting off the oil systems in America. It's crushing America right now. So credit is going out and the economy is crashing as we speak. And I think Powell and his friends are laughing all the way to the bank because they're not putting money back into the system.
Well, so yes, they've increased the interest rates to make it more difficult for people to borrow. They want people to borrow less and spend less, so there'll be less demand, and that will cause inflation to fall. And they also want to take away some of this new money that they created during the pandemic, also to make liquidity conditions tighter and to bring down the inflation. Well, when it becomes more expensive, when interest rates go higher, then it becomes impossible for the consumer to be able to afford to borrow money at the higher interest rates. So that kills the demand, and people just have to stop buying. So the companies can't push up their prices because if they do, they won't be able to sell their products. So the demand drops, and then the companies either sell less or they begin to reduce their prices. And that's how the inflation comes back down again.
Yeah, so there's two things happening, is that interest rates are going higher and they're pulling liquidity out of the system. So people can't spend money. And so that's causing this huge crisis because we said pretty much there's two things, right? Like interest rates are higher, they can't borrow, so that's less money coming into the system. Plus they're QTing it, quantitative tightening it, They were drawing money out of the system, and then suddenly you see businesses start to fail because mom and pop don't have any money because they're maxed out on their credit card. I mean, that's the macro system there.
That's right. But what we've seen up until really right now is the economy has been surprisingly strong. And the reason why it's been surprisingly strong is because the government handed out so much stimulus during the pandemic, roughly $5 trillion. And the Fed financed that by creating $5 trillion new dollars and essentially financed the whole thing. And by sending out stimulus checks to the Americans, suddenly they had a lot more cash. And this is not small change we're talking about. This was an enormous transfer of wealth, essentially from the government, or you could say future generations, to the present generation, giving them this was spending almost like on a wartime basis. When the government has a war, it spends enormous amounts of money, and that makes the economy boom because of all the government spending. Well, this is almost spending on a warlike basis, and it's carried the economy through right up until the most recent quarter. The most recent GDP was up 2.4%, much higher than everyone had been expecting. But I think we're getting to the tipping point now within the next couple of quarters where this is going to go into reverse because of the higher interest rates and because the Fed is destroying almost $100 billion every month and taking that out of the financial markets.
I don't know if you've seen it, Richard, but student loan debt is $1.7 trillion, is the number one asset America has today. So America the American economy is being supported by kids going to school, they take out student loans. Those loans I wouldn't touch. Kim and I have a lot of debt, but I would never touch a student loan. But things are changing so fast. When I met Kim, I was talking with a man named Dr. R. Buckminster Fuller, he had just passed. And Fuller talked about the thing called accelerating acceleration. In other words, there's acceleration, then there's acceleration on top of the acceleration. And that's what's happening today. And so millions and billions of people are about to be caught flat-footed. Just look at what AI is going to do, plus the lack of integrity of our governments. I'm not speaking Republican or Democrat, liberal or conservative, but there's been so much corruption, and what Fuller said we're going to do is enter the age of integrity. I think we're entering it right now. Look at the Fed's going to destroy $95 billion a month. It's going to crush mom and pop. At the same time, AI is coming up. Same time, India is coming up. The point here is this: with the right financial education, it doesn't make a difference what the Fed does or what Biden does or what the world does. Big question is, what do you do?